So one of the conversations that I've been having a lot with people lately, because I have a lot of clients who are looking for houses right now, probably have about 30 clients who are pre-approved and looking for houses, is that mortgage insurance is not bad, right? Everybody has this idea that when they're buying a house and they're getting a loan, that mortgage insurance is bad, 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 right? Mortgage insurance isn't bad. In fact, mortgage insurance is how you can buy a house with a conventional loan and not have to put 20% down, right? If you don't put down 20%, you have to pay mortgage insurance. It's either going to be rolled into your interest rate, which means you pay a higher rate for the life of the loan. It's going to be paid upfront by you, which some of my clients do for specific situations, or you pay for it monthly. Well, if you have strong credit and you have good income compared to your debts, your mortgage insurance can actually be pretty inexpensive if you opt for monthly mortgage insurance, but it also means that for the lender, it's a less risky loan. Lenders always offset increased risk when they're lending money by charging you more for the money. So if the loan is less risky, that means the rate is lower. I actually had a client this week who closed on a loan with mortgage insurance. Their interest rate was under 3%. I repeat, the interest rate was under 3%. For a 30-year fixed loan, they only put down 3%. So if you're getting a house and you're getting a loan, you want to have a conversation with your loan officers about how the mortgage insurance is going to work for the loan program that they pre-approved you for. If you're a real estate agent and you're working with buyers, sometimes encouraging your buyer to look at loan options that have mortgage insurance may mean that they have a lower interest rate. Keep in mind, if you get a conventional loan and you pay for mortgage insurance, at some point you're going to have enough equity in the property that the mortgage insurance goes away. With rates being super low right now, it may be better to get a low interest rate now, pay for monthly mortgage insurance, and then later, when the property has more equity, the mortgage insurance goes away, your client has a super low payment because they have a super low rate, everybody's happy. So again, mortgage insurance is not evil. Another thing, FHA mortgage insurance is super expensive comparatively speaking. And what I mean by that is, if I have two buyers that have a 700 credit score, a reasonable amount of money saved for their down payment and closing costs, buyer A gets an FHA loan and buyer B gets a conventional loan, the buyer with the conventional loan is actually going to have less expensive mortgage insurance, plus the mortgage insurance will go away at some point. Usually at 78% LTV, meaning there's 22% equity in the property, the balance on the mortgage is now 78% of the property value or the purchase price. The FHA mortgage insurance stays on there for the life of the loan. The only way to get rid of it is to sell the house or to refinance. What if interest rates are higher when the client goes to refinance than they are now when they're making their purchase? Again, FHA mortgage insurance, expensive. Conventional mortgage insurance can be less expensive if you have someone with strong credit. You want to make sure you're having these conversations with your buyers, letting them know, hey, when you speak to your loan officer, asking them about options for a conventional loan with mortgage insurance as opposed to maybe an FHA loan, or even if they have the financial means to do so, putting down a large down payment to get rid of mortgage insurance. I had a client that I sent a pre-approval out for yesterday. They're putting down less than 20%, so they have mortgage insurance. They're actually buying out the mortgage insurance. It costs less to buy out the mortgage insurance than if they made a larger down payment to get rid of it completely by putting 20% down. And because the loan has mortgage insurance, their interest rate is 1/4 point lower, meaning it's 0.25% lower. That means if I had a 3% interest rate, I go down to 2.75. If I had a 3.25, I go down to 3%. That's a big difference when you're talking about paying on a loan for the next 30 years on a home loan. So again, mortgage insurance is not evil. It may mean that you get lower costs for your money. So when you're having conversations with loan officers, when you're talking to your buyers, make sure you're having these conversations and telling them to ask about mortgage insurance.